Join us for this conversation now. We have Professor Uche Uwaleke, Director of Institute of Capital Market Studies, Nasarawa State University, KEFI, and he's also the President of Capital Market Academics of Nigeria. We'll also talk about the first trading week of November in the equities market. Great to have you, Prof. Good morning.
Thank you so much, Ladi. My pleasure being here.
Fantastic. Let's start with the Eurobond offering now. What underlying, fiscal or macroeconomic indicators in Nigeria, might explain the strong demand for the Eurobond issue, and how do these, relate to Nigeria's, debt sustainability trajectory?
Well, let me note that since 2011, Nigeria has been quite successful in the international capital markets. Recall that in January 2011, Nigeria first issued Eurobond. At that time, it was just to test the market, $500 million. Again, it was oversubscribed. So that trajectory has continued up, until this very one that we have had. Of course, it's against the backdrop of the relative macroeconomic stability that the country is currently witnessing. Stability in terms of moderation in inflation rate. Of course, investors are also looking at the fact that it would appear that the economy is beginning to turn the corner. External reserves are, on the rise. The country has also recorded for a very long time, current account surplus. The exchange rate has also stabilized. Okay, so these are some of the variables or components that form country risk assessment, that go into country risk assessment. And in recent time too, we have, recorded or witnessed favorable credit ratings, from major global, rating services. So investors, of course, took all that into cognizance, with respect to this Eurobond issuance. And that explains the reason too we had investors from virtually every part of the world. People showed strong interest from UK, from US, Middle East, Asia, and including Africa. And of course, eventually the Eurobonds are going to be listed on the London Stock Exchange, the Nigerian exchange here, and the FMDQ. So it's also a way of further developing our own domestic market. So talking about the factors, these are essentially what, in my view, must have influenced the strong demand for the Eurobonds that we issued. And of course, you can't also rule out the fact that the issue was attractive to investors in terms of terms, and the fact that global liquidity, was an issue. Liquidity in the sense that across the world now, particularly developed economies, rates are going down. And so when investors see opportunity for high returns on a risk-adjusted basis, of course they would fall for such.
Prof, looking at the macros at this point, we did mention inflation. We've had currency stability, and the strengthening of the naira. Talked about 1,470 to the dollar. Well, given the yields of 8.75% for the 10-year, 9.25% for the 20-year, achieved in the offering, what risk and opportunities do you think investors should be aware of at this point? Or are we out of the woods when it comes to inflation, interest rates, and currency volatility?
Yes, of course. If you also take into cognizance the fact that the reforms are just kicking in, talking about the fuel subsidy removal, the unification of exchange rates, including the recent tax reforms, which have all been welcomed by the international community. Of course, they are just kicking in, and I'm pretty sure the international community is also placing a lot of hope in the outcome of the reforms in the medium to long term. Okay, so that also explains why, in my view, the next couple of years, I also want to believe that these yields will eventually, moderate. They may not be as high as we have them, as the risks, or the reforms, they begin to yield, fruits. So there's no doubt that we have been experiencing some level of, macro stability. The situation today is not, as it were, obviously, in 2024. So I think the timing too is right. If we had done this in 2024, maybe we wouldn't have been as successful as we are today. That's also because of the improvements that I made, I referred to a while ago.
All right, so Prof, let's look at the markets now. Other sides of Nigeria's capital market. We're seeing November, starting off quite rocky for the stock market. We kicked off about 154,000 points, now 150,000. Sell-offs have wiped out about 1.8 trillion naira in market value. That's for the equities market within just 4, trading sessions. Some say it's a capital gains tax coming in 2026. What's your opinion, sir?
Well, of course, I think sometimes we should expect this kind of behavior, market behavior. For me, it's not very unusual, and I think it will be too early to begin to ascribe the issue of the CGT as being responsible for this. The CGT is not going to kick in till January, and to say that traders or investors are already beginning to take positions on the basis of that, would be, would I say, presumptuous. I don't think is the right, conclusion. Again, don't also forget that the threshold, we're talking about the CGT, the threshold, was increased. Section 46, sections 39, 46 of the Nigerian Tax Act. That is where you find the issue of CGT. It increased the threshold from 100 million to 150 million, provided the gains are not more than 10 million naira. But of course, for individuals, what it also means for individuals is that an individual too may end up paying less than the standard 10% CGT that we have today, because the CGT for individuals has been integrated in the personal income tax in the band, in the income tax bracket for the individual. So where the individual's tax bracket, for example, is nil, as with the case of maybe, of course, we wouldn't expect that kind of person to have that kind of volume, shares. That is what applies. The maximum, mind you, the maximum tax bracket for the individual is 25%. Now, for companies, yes, we are talking about 30%. By the way, the law also says that the president, can also, on the recommendation of the minister, reduce it from 30 to 25. So I think the issue is with the corporates, But as I mentioned earlier, I think it would be premature to say that what is happening now is as a result of the CGT that will be taking effect from January 2026. I think the major reason for what has happened now, in my view, is profit taking, and the fact that portfolio managers are also rebalancing in favor of fixed income, where we'll continue to see attractive yields. For me, that's the primary reason. And if you also notice, some of the earnings we've seen from some companies too, have not been as promising, and investors may be also reacting to some of those earnings. But I think that this will reverse. Before the year ends. Year-to-date return is still is still strong at 49%, about 49%. Yes, the last time I checked, that's still way higher than inflation rate of 18.02%. So it's still positive, real positive, rate of return from the equities market. And if you also check the major indexes, apart from the banking index, where we are, recording 35% year-to-date return, and the oil and gas, for obvious reasons, 7% year-to-date return. Major indexes have outperformed even the all-share index. Talking about consumer goods index at over 100%, talking about industrial goods index at 66%, and even insurance, at over 70%. So overall, one can say the market, has done well this year, and and I think the market will finish up strong, by December. So I think I don't think it's something that we should worry about. It's a phase. Once this season is over, I'm sure the market will return to its bullish trend, if you like.
All right, I guess you heard it from the professor there. Just good old profit taking. That's what's kicking off in this first trading week of November. Thank you so much. Professor Uche Uwaleke is the Director, Institute of Capital Market Studies, Nasarawa State University, KEFI, and also the President, Capital Market Academics of Nigeria. Thank you so much, Prof, for sharing your TGIF with us. Thank you.
Yeah, thank you, Latif.